Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Philip Peterson, Chief Investment Strategist at IG Wealth Management, will be joining us for the hour. In 30 minutes, we'll preview the Federal Spring Economic Update. Coming out later today, we'll be joined by Pierre Cleroux, Chief Economist at BDC. And of course, we want to hear from you this morning on First Call. Reach out with your questions on sectors, and we'll have Philip Peterson answer as many of them as he can at the end of the show. The number to call will be 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. The federal government is set to announce its fiscal update this evening, according to recent data. Canada ran a budget deficit of close to $26 billion between April and February, while short of the $78 billion projected in the annual budget plan. Prime Minister Mark Carney saying yesterday that the update will deliver encouraging news on the country's public finances. Shares of Celestica are down in the pre-market 13% right now. First quarter results for the electronic components maker featured a smaller upside to expectations than in recent quarters. Toronto-based company raised its full-year forecast. However, analysts say it had been facing higher expectations. According to a Citi analyst, Celestica's annual sales guidance is prudent given the management's conservative style. Shares of Spotify are down 11% in the pre-market. The music streaming service missed expectations on its operating income outlook. Forecast for premium subscribers for the current quarter also came in slightly below estimates. Now, on the upside, the Swedish company gained 8% in revenue and beat estimates on monthly active users. And now our top line story. Shares of major companies tied to OpenAI are under pressure in the pre-market after a report by the Wall Street Journal raised fresh questions about the AI startup's growth, putting renewed focus on whether demand is keeping pace with heavy industry spending. Now, the move is adding to investor caution ahead of tech earnings as markets look for confirmation that companies remain committed to the massive investments in artificial intelligence infrastructure. For more on this, let's bring in our guest for the hour, Philip Peterson, Chief Investment Strategist at IG Wealth Management. Phil, thanks as always for joining us.
Pleasure. Thank you.
Your thoughts on what's unfolding with AI? We'll start with basic thoughts, general thoughts on it.
Certainly. So I think it continues to be an evolving technology, one that the developers continue to put out new models going forward every day or every week. There's a new one, and the enhancements, you can see it's real and things are improving on that side. And then you have the utilization of that. Companies like my company and other companies that are trying to figure out how we're going to use AI going forward, how we're going to monetize it in a way that enhances our productivity or cuts our costs. And the interesting thing about it is that as each model improves, then we, the users, tend to drift more towards one versus the other. So, Claude comes out, Anthropic has a new version of Claude that is fantastic in terms of programming, then we tend to steer more towards that. Or if Chat has a better version, you move towards that. So it's going to continue to evolve. There isn't one that's the best yet. Everyone is improving at a different pace.
Well, it's really like any other industry, nascent industry that was starting up. Henry Ford probably dominated, and then everybody said, wait, we can build these too.
Exactly. That's exactly it. And that's why I think we're going to continue to see this volatility of results going forward, is because as every model comes out, one's going to be slightly better than the older version and the other versions from other companies that are out there. And then it's just going to be hopping from one model to the next model to the next model until you settle upon this is where we're going to put our mark or our line in the sand.
And of course, a big concern, CapEx and spending. Are you seeing results from what you're doing, like using it? Are you seeing savings, or are you seeing it work for you?
We're definitely seeing higher productivity. We're definitely able to do more with the number of people that we have on board. And as we continue to explore with it, it's a time saver right now. It is, I'll say this, when we look at the industry, it's not eliminating jobs, it's eliminating tasks. And I think that is the clear distinction here. It is giving us time back to focus on other things. So it's making us much more productive.
And the big fear, of course, is that it will replace people. But in the end, you still need people to think about what it's producing.
Exactly, and that's it. So I'm not a huge believer that we're going to see massive layoffs as a result of AI. And if you go back in history and look at other technologies that have been developed, it actually increases the overall demand for labor. It might shift the tasks that for example, one individual that is responsible for who knows what it might be, that task might be replaced by AI, allowing them to upskill and do something else. So I'm not a believer that it's going to result in significant layoffs, and there's no evidence of that today.
And then with the sales at OpenAI, the concerns of not meeting targets and new users, I mean, it's just a kind of healthy situation. Is there room for all these AI companies to survive, or is it
that's the question.
Fight to the death?
Ultimately, that's the question. I mean, when we look at it, Claude, for example, is great on the programming and coding side of things. Chat is good on more, I would say, the creative side of things and helping us build macro monitors and so on. Ultimately, we'll see if there's one that rules them all. But at this point, they're niche players, I would say. And if that's the way it's going to go, then there will be room for more players out there.
And with the suppliers like SoftBank, we're seeing their numbers down. CoreWeave, Oracle. It's just they're just going to have to think about who they're working with. They're going to have to work with everybody, aren't they?
Exactly. And the risk here, and we've heard this before through some of the other AI leaders, is overbuild. Is there a risk that we're going to overbuild? And I think that is the real risk right now. With all the money going in, companies are operating as if they're going to be the leader, and they might not be, and they might have excess capacity. Over time, I think that capacity will be utilized, but we could be in the case that companies are overspending right now to try and gain as much share as they can. All
right, I want to bring in also Celestica. It's down 11% in the pre-market, or at least more recently. What's it down? No, it's down almost 14% now. It missed as well, or not meeting the high hopes, but it's cautious, and some of the analysts were saying, well, that's not a bad thing that they're cautious.
Yeah, and look, this is a reset of expectations. I don't think there's anything wrong with the company. In fact, they met in terms of their earnings and revenue. It was the guidance that perhaps was a little bit softer than what the street had thought or had hoped for. However, also look at where the stock has come over the last month. Up more than 50% over the last month. That's significant. So yes, we're down 14% today, but it's just a reset of expectations, and expectations that coming into it were probably a little too lofty.
And one of the quotes was they're a conservative company, and this is how they kind of do things. So
that's exactly it, and I think it's responsible. But this is the market, right? If you're going to run up a stock more than 50% in a very short period of time, well, you're going to adjust back to reasonable expectations.
Take a little profit off the table with it, and everybody feels like it's just kind of feeling out what's unfolding with AI.
That's it, and
software
exactly. But it's not even just limited to software. We can see this in the consumer discretionary side. We can see this with other sectors as well. That expectations are so high, and look, we continue to bump up on new all-time highs, whether it be the S&P 500 or the TSX, so that if expectations don't completely, or guidance doesn't completely blow out prior expectations, then you are going to get a bit of a reset or a readjustment. This is healthy. When markets come back like this.
Do you think we'd see more than a reset?
It's a great question. It could. Valuation is not cheap in the marketplace, and I think that we are riding on this high of hey, we can put the war aside and get back to the fundamentals of the global economy, which are good. I don't think that we'll see a full correction, but could the market be down a couple percent, or certain companies adjust by upwards of 10%, given the rally that we've seen in some names? Yeah, I think that should be expected.
This is one of the few times in the last 2 months that I haven't had a first conversation without mentioning oil or the war. I mean, it's kind of gone off to the side, yet it's still there.
It is still there, but I think it comes down to the realization that, yes, oil prices are bumping up at $100 WTI, over 100 for Brent, and we see it at the pumps. But how does that impact the consumer? Yes, it is impacting us. We have to pay more for energy, but is it a significant deterrent to other consumption spending elsewhere? And the answer is no, not right now. I mean, oil prices are still very, very manageable. I mean, if we didn't have the war and oil prices were $100, we wouldn't be complaining as much as we are. But I think it's because the catalyst of the war that sent prices higher, that's what people are fixated on. But the reality is that the price of oil is very manageable today.
All right. On that note, we'll take a break. We'll take a look at the markets before the bell, and we'll be back with Philip to get his expectations for the Bank of Canada rate announcement tomorrow. see how things are shaping up on the markets. We'll start with U.S. futures. And you can see the Dow is in the green at about 1.4%, for the NASDAQ reacting to some of those tech numbers. And it's off by about 1.3%. S&P 500 as well, down by 0.7%. Off to Asia now. And they are all in the red. Nikkei off by about a point. Same for the Hang Seng, and the CSI 300 off by about a quarter point. Off to Europe now. Let's see how they're reacting in real time. And similar situation. FTSE's a bit of a wash right now. You can see the CAC off by 0.37 and the DAX by 0.47, again on those tech concerns. TSX yesterday had another off day, slipped down to 33,000, a little over 33,800, off by a quarter point. Some of the movers and shakers from yesterday. ARC Resources, look at that, up 21%. Kelt Exploration, 13.48. Going the other way, Allied Gold off by 4.5, and B2 Gold off by 8.5. And looking at gold, you can see it's dropped. It's down 2%, more than 2%, below 4,600. Silver also off by 3.2 as oil moves up, and it's down to $73 an ounce. And copper below that $6 mark, off by 2.2%. And Western Canadian Select, that upward trend continued for oil that we were just talking about. It was up 2.25% to 75.31. And WTI today, look at that, back above 100, up 4%, 4.2% right now, over concerns about what is unfolding in the Middle East. Well, the Bank of Canada is likely to hold interest rates steady as officials weigh the inflationary impact of the war in Iran against the economic damage wrought by U.S. tariffs. We're back now with Philip Peterson from IG Wealth Management, who believes the economic conditions in Canada warrant a dovish tilt by the BOC. But are they feeling dovish, Phil?
Well, I think if we look at the past statements, they have been leaning more dovish in the statement than hawkish. Now, they've often said that they're going to let the data guide them,
which isn't a bad thing.
Well, it's not a bad thing at all. But if you look at the data, then the data suggests that they perhaps should be cutting before the end of the year, at least one more time. That's because the labor market has somewhat stagnated. We're only creating 7,000 jobs a month on average over the last 12 months. GDP year over year for January came in at 0.6. For the fourth quarter came in at minus 0.6. So, there's
even talk of a technical recession, right?
Exactly.
Could be after this quarter.
That's it. Well, it's hard to say because oil prices in March might lift a GDP growth modestly, but that's price. It's not volume. It's not productivity. So if the Bank of Canada, yes, their focus is on inflation, and inflation's nudged a little bit higher, but raising rates won't change the price of oil. It won't stop the war in Iran. But cutting rates could offset the higher price of energy that Canadians are burdened with, and also go a little bit ways to support the Canadian economy. So we think that it's all about the tone, but the tone might come in more dovish than the market thinks.
And there is a bit of a psychological factor, isn't it? I mean, how often does that come into play for the bank? I know it's hard to bring that in, but sometimes a cut can be good for how people are thinking and feeling.
Exactly. And maybe they don't even need to cut. They just say, hey, we're watching and we're ready to take action, as opposed to the fear of, no, we're going to raise rates in the face of inflation. Putting a cut might alleviate some of that stress of, well, our mortgage rate's going to go higher over the next month. We're going to renew in the next couple of months. What does this mean for us? No, rates might go down. Okay, wipe your brow and you can breathe. And you
have a huge renewal rate coming in this year. And for people who are in at like 2,
exactly,
1.8%.
That's exactly it. The first 6 months of this year is the peak renewal shock for mortgages. We look at it, the 5-year rate that's expiring and the 5-year rate lifting. This is the highest rate of change in that. It rolls off come June, and it gets better. But anyone renewing their mortgage now is facing the biggest shock of the last couple of years.
And the mortgage rates haven't necessarily run along as well, as much as they normally would with the Bank of Canada rate, has it?
No, exactly. Mortgage rates tend to be priced off the middle of the curve. Yeah. And if you look at it like the 5-year government bond yield, it's stayed fairly stagnant. It hasn't moved that much. We've had a bit of a flattening of the curve. But that's the short end coming up more than the long end coming down. So mortgage rates have been fine, but it's still that sticker shock of what are we dropping off versus what are we picking up.
I had to renew 3 years ago, and I went with a fix for the 3 years, and it was like, because if I'd gone variable, it was insane how much it would have gone up a month.
Exactly.
There had been talk at one point that maybe we might see a hike at the end of the year.
It's still priced
What
into
would
the
that
futures
take?
markets. Yeah, it's still priced into the futures market for December that the market thinks that the Bank of Canada will raise rates. I don't think that's going to be the case at all this year, and I think the tone out of the statement this week might change that. I think that was a function of inflation from the war. If you look at the futures market and the expectations for it, it jumped to 3 hikes by the end of the year, immediately at the start of the war, came back down to 2, then 1, and I think we'll see, again, this is our view, but following the Bank of Canada statement this week, that's going to dissipate and potentially we can see a cut being priced in.
What about the economic update from the Feds? Is that a factor at all? I mean, not obviously for this meeting, but will that play at all into how things unfold? I
think it could. And I'm expecting, I'm hoping for positive news out of Carney and the government in terms of adding additional stimulus, whether it's on the industry side or the consumer side, just because of the economic realities of the Canadian economy right now. We are very lackluster with respect to our growth compared to what's going on in the United States or elsewhere around the world. So, providing a bit of a boost and those deficit numbers, I think, allow for that. That would be a positive.
And just want to get your thoughts on the sovereign fund announced yesterday. What do you think?
I think it's a great idea. I think this is a great idea. I think it's a long time coming, and I think if we want to invest in Canadian projects that will help boost our economy, doing it through this vehicle is a very, very appropriate way to do it, as opposed to just saying, well, we'll just cut it out of the budget and we'll see what happens in 10 years.
And I think does it get people connected, and does it attract foreign investment?
It could. I think it's more, domestic investment.
Yeah.
I think that's ultimately the goal.
Okay. All right. We'll wrap it up on that note there, but we've got lots ahead. Up next, we'll be back with Philip Peterson to see why he sees attractive investment opportunities in the Canadian energy sector. Okay, time to see what's on the radar for Philip Peterson, Chief Investment Strategist at IG Wealth Management. And we'll start off with the Canadian energy sector. We've touched on it a little bit with everything that's unfolding in Iran. Why are you liking it right now?
Right. Well, you have to think about the disruption that we've seen out of the Strait of Hormuz and with oil in general since the start of the war, right? Where if you're displacing 20 million barrels a day, it's not so much that if the war ends tomorrow, the strait opens up and this oil
Everything's
flows.
all hunky-dory.
Exactly. That's not the case. It is supply disruptions. You do have to get back to where you were before. And so this is likely to go on. We're likely to see higher than beginning of the year oil prices for an extended period of time. We're thinking in the $85 range. Mm-hmm. So oil will settle down, but still.
Now, what's an extended period to?
It could be 6 months.
6 months?
Before we're back to normal. So, it could be before the end of the year that we see oil supply really normalize again, and that's going to keep prices higher. And I think that is the attractive element to the energy sector, is that we can't just think that, if the war ends tomorrow, then energy stocks are going to be down 20%. That's not the case. They're still going to be generating significant amounts of money. And more to it is that they're quite cheap. So if you look at, let's say, Suncor, for example, is trading at 10 times forward PE based on expected earnings. So that isn't even pricing in full year of oil at $100 for WTI, or even if it's 75 for WCS, that's still very, very attractive. Then you layer on top of that what happened yesterday with Shell and ARC.
Yep.
Now you're starting to see some M&A activity pick up. This is another positive that could be a boost to other energy companies, or at least set a valuation level for the energy companies that might be underappreciated right now.
Do you think that's going to be a trigger for M&As?
I think
are other people in the hunt? Because
yes.
Shell was struck. Shell was done less than 5 years. Was that right on their supplies?
Yeah. And so I think this will bring attention to other good producers in the oil sands or in Canada in general.
Yeah.
That foreign buyers might look at and saying, hey, this is a way of expanding our production, growing with a very, very solid footprint going forward for decades. And so I think it makes Canada attractive again.
And with the instability in the Middle East and the vulnerability of the, and now they're talking about the Malacca Straits is another one they're talking about being vulnerable, but the vulnerability of the Strait of Hormuz, will that, do you think Canada can take advantage of that, or is it just going to, as soon as we get back to normal in 6 months, assuming we do, everybody forgets that anything even happened there. It's fine.
It could be that, but I think Canada can definitely take advantage of it. And you're hearing about new pipelines to tap into Asian markets, to tap into the European markets, whether it's on oil or natural gas. And I think there's a real opportunity there. If there's going to be instability in the Middle East, and look, this might not end even if it ends, meaning it can go on forever. It has gone on for 50 years now. So maybe like we've seen with COVID and the shifting of supply chains, it becomes a shifting of supply chains with oil as well.
I mean, there's a huge market in Europe for natural gas between Russia and the Middle East. How do we get it to them, though?
Well, LNG facilities and pipelines,
yeah.
Right? The technology is there. It seems that we have the willingness of the government now to do that as well. It's a shift in the government sentiment that, no, we can be climate responsible and energy, a key energy supplier to our allies, East and West. We just need the right attitude.
That was so diplomatically phrased. Okay, let's move on. We chatted again. Big software's in the news again. Let's talk a little bit about software. It's SaaSpocalypse. Is it?
Well, I think it's company by company, right? Yeah. We really have to look at it. Right now, what's happened is almost, it seems that there was a blanket sell-off of all software. If you were a software provider of any sort, you were down. Look at Microsoft, which is one of the examples we like to use here, down 30%. Well, Microsoft is a going concern. It's not going to be displaced by AI. Elements of it will be enhanced by AI, but Microsoft can tap into that and monetize that. And so look at what we've seen just over the past couple of weeks. It's up 20%. The IGV, which is the software ETF index in the US, up 15%. So it's not the doomsday scenario for all software providers. There are great opportunities out there. You just have to be a little bit more discerning in terms of, is this a going concern or can this be easily replaced by AI?
Well, you would assume and you would hope that these companies, they're good at what they do. They're looking at AI and figuring out how to incorporate it.
Absolutely. You hear that
and
from
even
Microsoft.
Maybe transition entirely.
Totally. That's what you hear from these companies. They're not going to sit there going, no, we're not going to utilize the new tools. So what they're saying is we are going to take these tools and enhance what we have. And if we can build it into our infrastructure, then we're more valuable to our clients.
Did any horse and buggy companies make the transition to automobiles?
Oh, you're testing me now.
Okay. No. And U.S. banks, another sector you like.
Yeah, very attractive sector. So U.S. economy is quite strong. We can see a stronger IPO market coming in the fall. Capital markets and trading are showing positive or contributing quite strongly to the bank's earnings. And they're cheaper than what we see on the Canadian banks. Now, Canadian banks are fine. I don't want to take anything away from that. But when you look at the price to earnings or price to book value ratios of the U.S. banks versus the Canadian banks, you can pick them up at a 20 to 30% discount with very, very strong growth. We think that's attractive right now.
What would it take to make the Canadian banks attractive?
Well, we're going to see strong earnings out of the Canadian banks, but they're trading at a premium to their historical PE and price to book levels. And so I think even though the results can come in quite strong, the banks might consolidate and trend sideways for a little bit.
All right, we'll wrap it up on that note there. And coming up after the breaks, the federal government is unveiling its spring economic update today. We'll explore that with our next guest. And we are going to keep our phone lines open for our first call segment. 1-855-326-6266. Send us an email if you want. First call at bellmedia.ca. Barrick Mining expects to complete its initial public offering of its North American division by the end of the year. Spinoff is expected to have its primary listing in New York, secondary in Toronto. The miner also appointed 7 executives dedicated exclusively to North American Barrick. The division will include stakes in its projects in the U.S. and the Dominican. GM raised its profit outlook for the full year by $500 million. The automaker says its pickups and sports utility vehicles continue to sell even as gasoline prices soar due to the Iran war. The American company also beat profit estimates for the first quarter. Demand for GM's pickup and SUVs has remained resilient. The car manufacturer also faces lower tariff exposure than it expected a year ago. Shares of BP are up in the pre-market. First quarter profit for the energy company far exceeded expectations. Spiraling energy prices and market turmoil caused by the Iran war leading to a surge in profits from its oil trading operation. Strong production performance from BP's assets in the Gulf of Mexico and the U.S. offset disruptions in the Middle East, where the UK-based company has a relatively smaller base. And a quick look at the markets. The Dow, it's about a wash right now. It's up slightly, but a wash. And the Nasdaq, on some of those concerns about tech companies responding, it's off by 1.4. S&P 500 also being dragged down by about 0.75 of a point. The federal finance minister will table the spring fiscal update today. An earlier report from the Department of Finance posted a deficit below forecast. Prime Minister Mark Carney saying yesterday his government is determined to get spending down. Here to talk about that and more is Pierre Cleroux, chief economist at BDC. Pierre, thanks very much for joining us today.
Good morning.
The Prime Minister has promised good things. Do we have reason to believe that optimism?
I think so. I think the economy performed better in 2025. That gave some possible spending more for the government. So, like you said in your introduction, the forecast is good for the deficit. The economy has been resilient, so the government got more revenue than expected. So that gives them more options for the announcement today.
Pierre, do you think that means that the government might be able to provide some stimulus to maybe offset some of the tariff impact that we've seen on some of the industries in Canada?
I think so, and I think the government is going to announce a few interesting programs to stimulate the economy. Also, they have an agenda to transform the Canadian economy. They have made a number of announcements in the past. So I think in the budget today, they will continue to do so because it's transform the Canadian economy. It takes a long time. So I think we'll have a better idea today as what the government wants to do.
Where do you think some of that stimulus should be directed?
Well, the announcement has been already on infrastructure, so I think they will continue in this direction. If we want to diversify the economy, if we want to diversify our export, we need extra infrastructure to do that. They are also going to focus on our natural resources, which is a big asset for Canada. And also, they have announced in the budget in November, they want to focus on defense. And I think we will see more of that today as well.
Pierre, do you see any room in there for housing? Affordability is an issue, continues to be an issue in Canada. And is there any room to provide any relief to homeowners?
Well, the government already announced a very large program to build more houses in Canada. Maybe they will go more in detail of what they want to do for the next 5 years. But so I wouldn't be surprised to see that. But that was already announced before. So we'll see if they are going to continue in that direction.
And now they're also looking, it looks like the deficit's going to be down probably significantly. Is that something they should keep tackling, or should they use some of that deficit, run it a little higher and do stimulus?
Well, I think it's a good news, first of all, because the economy has been very resilient in 2025, despite the tariff. Despite the uncertainty, the economy grew by 1.7%, and the Canadian economy created more than 300,000 jobs last year. But we have to be careful for this year because we have a very slow start in terms of the Canadian economy for 2026. So I think the government has to be careful as their forecast because we might have a bit of slow year in 2026.
And then it might not be in this update, but CUSMA is going to be renegotiated starting in July. I mean, do you have any sense on what the government is going to be focused on with those renegotiations?
Well, I think the government wants to eliminate the tariff that the U.S. has imposed on Canada about a year ago. There's a lot of these tariffs have quite a negative impact on some sectors of our economy, like the automotive sector, the steel industry, the soft lumber industry. I think that's the number one goal for the Canadian government.
And I mean, there has been talk we either may negotiate separately with the U.S. or might even be thrown out. CUSMA, are any of those things being factored in as to what lay ahead for the federal government?
Well, everybody's forecasting about the same situation that we have now. So let's say the Canadian government is able to sign a deal without any tariff, I think that will just stimulate the economy. That would be a good news, and I think we'll have more export, more business investment, and that would just help the economy. But we're not sure yet. We'll see what happened, between in the negotiation between Canada and the U.S. and Mexico.
And Mexico doesn't get a lot of talk. Is that a factor at all with the CUSMA talks, or is all our focus really on the U.S.?
Well, our focus is more in the U.S. because we don't trade a lot with Mexico. Still today, 72% of our trade is with the U.S. But obviously, it's a three countries free trade agreement. So Mexico is important, but for Canada, the main focus is our export to the U.S. because, like I said, it's more than 2/3 of everything we export around the world. We do it with the United States. So this is the main focus for Canada.
And of course, the other huge event that's unfolding right now, the war in Iran. Oil prices are up. I mean, the government obviously benefiting from that. Is there a danger that they'll like benefiting from it, and when oil prices drop, we'll lose income?
Well, there's two impacts on Canada when the oil price is going up. So you're right, the Canadian government is getting more revenue, but at the same time, consumers are paying more. So this is disruptive for consumers. So actually, the best scenario is the end of the war. It's the best scenario for even for Canada, even if we're a producer, because on the other side, consumers are paying more at the pump. So the best scenario for Canada is the end of the war.
And with this report, what will the opposition be looking for? Are there any weak points that you could see in here that may show up?
Well, we'll see. I think probably for the opposition, the deficit won't go down fast enough. We'll see what are the decisions from the government, but that's probably what the opposition is going to focus on. Because despite, the news are good, but the economy is still slow. So that means that government revenue are still slow. So we shouldn't expect that the deficit will go down very quickly. So I think it was a good news for the fiscal year 25-26. But in the next few years, the Canadian economy continue to have a slow pace. So that means that government revenue are not going to increase very significantly. So that's a challenge in terms of the deficit. So I probably the opposition will focus on that.
Back to energy a second. With energy and oil prices being top headline news, do you see the government taking this as an opportunity to perhaps front load energy infrastructure projects in this announcement?
I would be surprised if they changed their strategy because, the situation right now is temporary. Nobody believes that the war is going to last for a very long time. So these investments are based on 10 years, 20 years. So I don't think the current situation will have an impact on infrastructure spending. The Canadian government has already announced a number of infrastructure spending in energy. I don't think the current situation in Iran is going to change that scenario, that strategy.
All right, Pierre, we have to wrap it up there, but thank you very much for joining us.
Thank you.
Pierre Cleroux is chief economist at BDC. Still ahead, we'll look at market drivers with Bloomberg's Divya Balji, including positive news from Bed Bath and beyond. And of course, our phone lines are open. Philip Peterson is taking your questions on sectors. Reach out at 1-855-326-6266. Email firstcall@bellmedia.ca. Time for a look at some early market movers, and we are joined by Bloomberg's Divya Balji, managing editor for breaking news in the Americas. Divya, thank you as always for joining us. Bed Bath & Beyond have been put to bed, but now it's getting up bright and early, a little spring in its step.
Yeah, definitely a spring in its step right now. Really strong revenue growth for the first quarter. They seem to be pointing to the fact that they invested a lot in the company over the last few quarters to improve efficiency, to cut costs, and that's really what's coming through in their latest earnings results. The CEO in particular said that this revenue growth, this meaningful revenue growth, they haven't seen in years, and now it's coming back. The CEO also said that he seems to think that the fact that they've put in this investment is what consumers are responding to, and that is why they've seen this revenue growth going forward. Revenue growth in the first quarter. I think what's going to be key here is whether or not they can actually continue along this path. It looks very shaky right now for a lot of retailers out there, considering the macroeconomic environment that we're in. Will customers spend or not? Bed Bath & Beyond perhaps is in a very good position to take on consumers that may not want to spend too much money, and perhaps these cost-cutting efforts might be helping on that front too. I think revenue is a key part of this, but also profits, they do have to show up for that. And will we see that in the going quarters? I think that's what's going to be key. You have seen a few analysts raise their share price targets. They seem to be very upbeat on the results as well. But again, it's the future of this company and where, all of this goes in the next few quarters that's going to be key.
All right, Coca-Cola is having a Coke and a smile. Where's that money coming from?
This one's also a very interesting one. If you were to look back at Pepsi when they reported, they also came out with pretty strong results. This is 10% growth in terms of organic revenue. And what seems to be coming out here is the fact that this company has actually customized, their sales based on their consumers' needs. You have lower income consumers that may not want to spend so much, might want less of a certain product. They're now, providing that to those customers while they continue to sell on their premium brands to the consumers that can afford it, to the more affluent consumers that they might have. And this is really what's showing in Coca-Cola's earnings right now. And I think it's important that you see this continue for this company, again, considering the environment that we're in, where you do want to make sure that you're serving all these different types of consumers that you might have, especially for a brand of this size. The stock is up, I believe, 2 or 3% in pre-market trading, so the market is quite pleased with the results that they've had.
All right, and last up is UPS. What's going on there?
Yeah, flying high, maybe? Can I say that?
Yes, you can, because I didn't say anything,
UPS,
so you go for it.
I think I think in this case, they did come through with very strong results in the first quarter, but the stock is actually down. And the reason for that seems to be that they actually kept their financial outlook for the year unchanged when perhaps the market was expecting a raise. FedEx did that last month when they reported earnings, but UPS is keeping it unchanged at this point. It's possible that it has to do with the fact that they're uncertain about the future with trade concerns still in the air, U.S. trade concerns in particular. Fuel costs is another thing that they're keeping an eye on, which is really why it seems like they've sort of maintained this outlook. It's always better to maintain your outlook rather than have to cut it in the future. So I think that's what they're going with. Stock is down about 3 or 4% in pre-market trading.
All right, Divya, thank you as always for that. Have a great day. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the market, including Propel Holdings. All right, let's take a look at some of the notable analyst calls and recommendations. First up, Propel Holdings was cut to sector performance Scotiabank this morning with a price target of $27. The cautious stance is driven by pressure on net income, specifically due to increased provisions for loan losses, which accounted for a significant portion of revenue in the fourth quarter of 2025. Now, the same analyst at Scotiabank also cutting his rating on goeasy to sector perform with a price target of $39. goeasy stock has experienced a dramatic decline in the past month. That's a bit of an understatement, primarily driven by a massive surprise spike in loan losses, the suspension of its dividend, and mounting concerns over its LendCare acquisition. ARC Resources was cut to sector perform at Peters & Co. with a price target of $33. Yesterday, it was announced that ARC is being acquired by Shell in a deal valued at $22 billion, including debt. The deal is expected to close in July. ARC is reporting their Q1 earnings tomorrow morning. Well, Prime Minister Mark Carney has announced a new fund that will let Canadians invest in nation-building projects. CTV's Mike Lecouture has more on how it works and where the funding will come from.
Canada's first national sovereign wealth fund. Using a Canadian Pacific Railway train as a backdrop, the Prime Minister says the new fund will allow Canadians to contribute to projects that will build the nation, like the Iron Spine did 150 years ago. The federal government will put up $25 billion and is counting on Canadians to also invest.
But we intend to provide it in a way where the investment itself, the actual amount of money, is protected. It's something consistent to buying a government bond, but has the upside, the additional return when these projects realize their potential.
Carney added the fund will operate as an independent arm's-length Crown corporation. He also compared it to Norway's wealth fund, which is worth more than $2 trillion US. But some economists warn there is a difference.
The funding model in Norway might work better because it's funded through surpluses. But here we need to make sure that we have a stable budget and get rid of those deficits before we think of injecting more money.
Pierre Poilievre points out the Liberals created the Defence Industry Bank and the Infrastructure Bank, which the Conservative leader contends have not borne fruit.
Borrowing yet another $25 billion out of the economy to subsidize projects that the government still cannot figure out how to approve.
All of those entities are helping underlying businesses at the core to move forward.
The Prime Minister sees this as an opportunity for ordinary Canadians to invest a little money into big Canadian projects. But with the ongoing affordability crisis, it's unclear how many people will have the means to do so.
That was CTV's Mike Lecouture. When we come back, Philip Peterson takes your questions on First Call. Time for First Call, and let's head to the phones. And it's Terry from Edmonton. Terry, how are you?
Good, thank you. Yeah, my question is I own shares in NDA Space, Telesat, all these types of companies. Do you consider these highly speculative, or would you invest in this area? Thank you very much, sir.
Cheers, Terry.
Great question. I think that it's company specific, and so in certain areas it would be more speculative than others. You know, when we think of aerospace overall, we like to think to the big players like the Boeings, for example, that have good results. They're ramping up production. They were involved in Artemis, and so this is something that we think is a little bit more interesting. And then actually extend that to the airlines themselves, whether in Canada or the United States. I mean, they're just booming in terms of their bookings. Even though we're seeing jet fuel prices higher, I think that this is an area that could be quite attractive. The other day, you had the United CEO confirm that he had reached out to American Airlines for a merger. So there's things happening here, and yet consumers are still flying everywhere. So, I would say look to the bigger players and the broader picture for that.
But it is space and the aerospace technology is garnering a lot of attention right now with everything that's between Artemis, between what's going on in the Middle East. But it's getting a lot of attention right now, isn't it? It
is, and for good reason, obviously, with the different technologies and on the military side of things, going from big missiles to small drones, and there's companies that can ramp up production of that could be quite profitable going forward. Maybe that's going to be the new military machine as opposed to $5 million missiles. But as far as looking at like MDA Space, for example, I think that one itself could be more on the speculative side.
Okay. Email now from Sylvain, who says, can I have your opinion on Nutrien? I would like to increase my position. Fertilizer, another one feeling the impact of the Middle East.
Exactly, because Strait of Hormuz, with the closure there, urea prices have gone straight up. And so urea being one of the key fertilizer inputs, Nutrien would be a beneficiary of that supply chain choke-off. And we can see it in terms of the price. It has come off a little bit from its high earlier in March. But as we move on through the year, I think that we're going to see higher demand for fertilizer companies like Nutrien.
And and also I guess that puts pressure on like the farming industry and the agricultural industry.
Oh,
sector,
totally,
doesn't it?
Absolutely. The flow through is likely to be obviously higher grain prices, which means higher food prices in general, and that could lead to modestly higher inflation in a year's time.
All right, good. All fun things to keep an eye on. Great. Okay. Email from Kurt now. Can you let us know the outlook for Canadian REITs over the next 2 years? Break out the crystal ball.
Yeah, certainly. I think over the near term, I think they're going to be less desirable because they're tied to the economy. And if we have a slower economy in Canada overall, then I think REITs are going to be faced with that headwind. Whether we're looking at apartment REITs or commercial REITs, apartment REITs, if you think about that, population growth in Canada now is flat or down.
It's negative.
Exactly.
Yep.
And so that has put downward pressure on rents, and you're seeing condos. Yeah, the sales of condos really drop. The number of condos available for sale explode. That will put some downward pressure on REITs as well. And then just from the broader economic perspective, if Canada has been slowing, if this continues, then you're probably going to see downward pressure on the commercial REITs.
And what about commercial REITs with malls? I know obviously the economy is a factor, but I mean, we talked about the death of malls, and now they seem to have enjoyed a bit of a renaissance.
Yeah, kids are going to the mall again, right? It seems that you're seeing more and more articles where kids are getting off their phones and going to malls, and people, when we go, you still see people there. And what I do is I focus on their hands because I want to see if they have shopping bags, and they do. So, I mean, we haven't seen quite the death of the mall yet.
So so there is some optimism for it, but again, the big economy is.
They're going to be tied to the economy, and if the economy is slowing, then the outlook for these things would be below market performance.
And longer term, is there a
longer
cycle
term,
to it?
There would be, obviously. It would flow with the economic cycle, and you have to think that the Canadian economy will benefit from what's going on around the world. So I would say if we're looking at a 2-year outlook, I'd be looking at the longer end or the tail end of that 2-year outlook for any upside.
All right, Philip, we've got to wrap it up there. Philip Peterson joining us today. Thanks as always. Andy's up next with the Open. Trading gets underway a little more than 30 minutes from now. Have yourself a great day.